Inflation and interest rates often move together, and the CPI helps explain why. The latest data shows inflation at 3.4%, driven mainly by housing and food, with many parts of the basket still above the Reserve Bank's target. Markets are already pricing in the risk that rates may need to rise again. Joining me in the studio to unpack what this means is Dr. Means, an expert across finance, inflation, and the economic headaches we're all feeling.
Great to be here. Thanks for having me.
Why does housing make inflation so hard for the RBA to control?
In simple terms, lower interest rates make borrowing cheaper, which brings more buyers into the housing market. That pushes up prices and rents. Housing makes up about 21% of the CPI basket, and it's currently rising at just over 5%, so it has a big impact on overall inflation.
What does that mean for homeowners looking ahead to 2026?
For existing mortgage holders, lower rates can ease repayments in the short term, but for first home buyers, cheaper borrowing brings more competition, which pushes prices and rents higher. If housing costs keep rising, that inflation pressure increases the risk that interest rates stay higher for longer or even rise again later.
And finally, from a data perspective, does the recent drop in headline CPI really signal relief for borrowers?
It's encouraging, but it's not enough yet to signal lasting relief. Inflation pressures remain broad based, especially in housing. Financial markets seem to recognize this, which is why futures pricing still reflects a meaningful chance that rates may rise again.
Dr. Means, thanks for joining us and explaining why the cost of living conversation isn't over just yet.
Thanks for having me. Stay safe, stay risk balanced.